The end of the cheap money era is probably inevitable. How will that affect Middle Eastern economies? That's the subject of today's edition of Inside AB. I'm Jeremy Lawrence, joined here in the studio by Cheyenne Shakil. Shay, welcome.
Thank you.
Just quickly explain before we start what cheap money is and why that's going to affect us here in this region.
Well, the most important thing to understand is fiscal policy is different from monetary policy. Fiscal policy is like finances, how governments control taxes and spending. Monetary policy has to do with money, so the supply of money. Now, what happened was a decade ago in the financial crisis, like liquidity dried up because banks had made a bunch of bad bets, and what that meant was because the U.S. is the world's largest capitalized market, it just had a chokehold all across the world. The way to fix that was that the U.S. Federal Reserve dropped interest rates to near zero. So it allowed, cash to flood the economy, and somehow, the economy didn't grind to a halt.
Now and that's carried on ever since, basically.
Yeah, and that's what quantitative easing has been. I mean, there were a bunch of other measures, but this was, for the topic of this conversation, the most relevant one. Now, with lending at the lowest rates in history, what happened was that it spurred a slow recovery, but inflation rose as well. Now, the Fed says that inflation should be at about 2%, but it's rising too fast, especially in an expensive oil environment, that it could go beyond what it, wants it to be. So it started raising interest rates, and now that's affected the world because the dollar is the world's reserve currency, and so money is effectively getting more expensive.
Right. So why is that going to affect us here in the Middle East? And tell us which countries it's going to affect.
Well, the U.S. economic recovery is ahead of the developing world. So some countries in the Middle East like Egypt, Jordan, Lebanon, Morocco, and Tunisia, they already have high government debts on which they pay interest. High interest rates mean that they have to pay or borrow more to service those existing debts. And those debts are denominated in dollars. They were cheaper, but now the dollar is stronger, so they have to pay even more. And what we've seen is that, if the dollar continues to appreciate and interest rates continue to increase, the governments will have to change their fiscal policy in response to the U.S.'s monetary policy. And one of the main ways to do that is, by cutting back on investment in, spending on building roads or, human capital investments, things like that. That's a huge portion of the consumption function, which is what, you measure when you talk about things like the GNI, gross national income, or gross domestic product. And so when they divert that spending to service debt, that obviously means that the countries won't grow very fast. Now, Tim Fox, the chief economist and head of research at Emirates NBD, says the average debt for the 5 countries in the Middle East in 2008 was 77.3% of GDP. Right now, it's 93.7%.
Wow. And what sort of effect does that have on these emerging markets when it gets to that level?
Well, we already said, how these countries service debt.
Yeah.
But what happens is when those indicators, there's tons of indicators for unemployment, inflation and things like that, but GNI and GDP, when investors start seeing those indicators declining, they start pulling their money out of those economies. When they pull that money out of those economies, what happens is they're selling assets which are in local currencies for dollars. So the dollar continues to appreciate even further, local currencies fall even further. Now with that cheap local currency, you have to pay back expensive dollars. The dollar's interest rates are rising, so the dollar's growing more expensive. Pretty vicious.
Vicious cycle, exactly. So what's the way out? We mentioned these Middle Eastern countries, of course that's our focus. What's the way out for them? What's the prognosis?
Well, the GCC is in a different situation compared to the rest of the Middle East countries which we've defined, because these countries have their currencies pegged to the dollar. And they're also oil exporters. Now, in a time of rising oil prices, they earn more, so they can pump money back into the system. And a higher dollar just means they get more money for their oil. What the rest of the countries suffer from, if you want to call it that, is that they're net oil importers with high levels of debt.
Yes, that's what we were talking about with those 5 countries, all net oil importers.
Absolutely. Now, what we can see paralleled, or what's reflected in Argentina and Turkey. Now, their currencies, like Turkey's currency, fell by almost 50%. It's declined to half its value over the course of the last 12 months. Argentina is a similar situation. Now, these countries, Egypt and Lebanon, spend 1/3 of their total expenditure on debt. Egypt's debt servicing has doubled, in fact, from 2009. Jordan, Morocco, and Tunisia spend 10.3%, 13%, and 7.3%. So obviously, you expect that it's going to be a bit tougher paying all that debt back. what also affects these countries is because they're net oil importers and oil prices are rising, it contributes to their fiscal deficits, which is basically how much a country earns and how much it spends. So their bank balance is effectively negative. That deficit right now is 6.8%. It's better than it was in like 5 years ago, when it was at 10.4%. But that was when oil prices were $100, which is where people are saying oil might be back at soon. What makes it worse is that cheap money is coming to an end.
Right. Okay, so that's not really very good news, is it, as things stand?
Well, Tim Fox says that, we're not on the verge of a crisis, so don't expect a catastrophe. In fact, in his words, he says, the trajectory in terms of reducing fiscal deficits is broadly in the right direction. Broadly being the key word here. But he does expect slow progress in continuing to reduce those deficits, given, all the stuff that we've talked about. And this will eventually weigh in on the ability for those governments to invest in physical capital as well as human capital. And, based on what we've been talking about over the last few weeks and months at Arabian Business, human capital investments really shouldn't be reducing right now.
Right. Fine. Well, okay. Well, let us know what you think to that. The end of cheap money, rising interest rates is going to have some kind of effect. Is it going to be catastrophic? Will we learn to live with it in these countries? We'll see. Keep your eye on Arabian Business. Do keep tuning into Inside AB. Share your thoughts below. We'll see you tomorrow if it's a weekday at 10 a.m. Bye.